Hi, this is Randy Finney with the right side of the chart, and this is a mid-session update for Monday, May 1st, 2023. It's 12:01 p.m. Eastern Time. I'm starting the video, so we're smack in the middle of the trading day. Not a lot new to report. We're pretty much picking up where we left off on Friday, and that is, of course, as I said, then at the top of the trading range. So it's, just kind of wash, rinse, repeat, run up to the top. The purple box is a trading range that I've had. This is the late March through now into May trading range. So it's a good solid month. And then if you look here, we have I've added a larger box on the 60-minute that kind of comes in and catches that gap up right there. You have a reaction low there, and as I said last week, at this point in time now, I think what the bears need to see in order to spark that impulsive wave of selling or much larger wave down I'm still looking for, of course, remains a break of last Tuesday's lows right there, and that's give or take just a hair under 310. So I have that at 309.92, but that's it. So that gives us a larger box there, and that's pretty much, again, needs to be taken out in order to make a strong case, or a case to aggressively be short or add to short positions if you already have that. And if you're long, likewise, do what you want to do. But if you see a failure back in here, remember we took out the top of the trading range Friday and today by ever such a slight margin, it's hard to even see it here. These are your two previous reaction highs right there. And so for all intents and purposes here, we're really at about a triple top. So we are above, I will say that, we are above resistance by a hair. But again, a lot of red flags, not the kind of breakout that I would be taking at this point in time, because you have a lot of bearish evidence in the chart that says that breakout's likely going to fail. And on top of that, more importantly than just my read of the charts here, is the fact that we have the Fed on Wednesday, 2 p.m., Fed rate. They're pretty much baked in the cake. Another quarter point hike. I think I looked today, the odds are 92%, I believe, which surprises me. I'll talk on that one second to see it that strong. But and then you also have, again, what I was circling here, you have the bearish crossover close to, but it's not yet happened. In my opinion, you have divergence, of course, anytime. That's not my opinion, it's fact. When prices on a security are making higher highs, which we have been, and this is a marginal new high from the same divergence. It started back here in mid-March right there, and you can see we had divergence at that high right there, and that's where we started the trading range. And I'll give the market points for that. It's been correcting more in time, or pretty much 100% time, more so than price, complete sideways trading range. But you do have, with today's marginal new high, the divergence is even larger. And you can see there we have, it's not confirmed yet, but a high level bearish PPO crossover. You can see the PPO has made a sharp turn down. That's the blue line. And when it crosses the white line, that's the signal line. That'll be a bearish PPO crossover. That'll help to confirm the divergences. Yes, the Fed has the ability to foil, bullish or bearish developments on the chart. So does Apple, the largest, typically for years been the largest holding in the NASDAQ 100 and S&P 500. But let's keep an eye and see if we get that bearish PPO crossover to confirm the divergence. And it's a high level bearish PPO crossover. Usually when you get that, you at least have, even in a bull trend, some correction. There was a peak right there, and that set us down immediately and then sideways for weeks. Here is a high-level bearish PPO crossover that marked that peak right there, followed by correction. So we'll see. I just want to point out what I see, and just to reiterate, sound like a broken record, but nothing's changed. We still have the divergence on the more significant daily time frame as well. And what we need to see for the bearish case, and if you're long, what you don't want to see, is a move back down into the trading range. If you solidly fall back in it, the MO is to, or from my experience, typically once you have a false breakout of a range, the next move is the other side of the range. Just like when we had the recovery back here, and then you took out the downtrend line. Like I said, I was willing to allow a little bit of pop there, but I said that day if we took out the trading the top of the line, we're most likely going to go to the top and quite possibly even above the top of the range, and that's what's happened, and that's usually what will happen. So again, top of the range, next stop is the bottom, bottom of the range, next stop is top. Any failed breakout likely sends you down to the other side of the range, and usually in very fast order too. So that's it. Watch those levels. You know where I think we're going, but that doesn't guarantee we're going there. So we'll see what happens on Wednesday. And I'm going to talk about a few other things here to watch. So that's QQQ, and that's what it looks like on the daily. That's my busy board. I think I have a clean board somewhere right here, really. So you can see, I'll draw it up for you. There's the divergence that's been building, building, building. And as I've been saying for weeks now, if not a month or more, in my opinion, this is the best setup for a short trade, swing or trend short in a while. Again, first time we had negative divergence on the daily time frames since the market top back here. Okay, I'm going to cover a few other things. I'll do an update on gold, silver, the precious metals, but stocks to watch now. While I'm on the NASDAQ 100, let me talk about Amazon. Amazon, of course, earnings are out of the way. This is my busy board, and what I'll highlight here. Let me just clean this up, give you a clean board here. So we recently got rejected on this downtrend line right there. You have a reaction high there, there. So you can draw now. You have three distinct reactions, nice and clean, right? I had multiple trend lines on the other chart. So a lot's happened, and now earnings are out of the way. Like I said, you got to give it a couple days. The market will then choose its direction. Amazon, I feel bad for the poor suckers that bought this stock, ripped in the after hours on earnings. And as I always say, there's three components to an earnings report. There's the actual earnings, and then you see the spike, either rip or dip. And then there's the conference call, and quite often, very often, I've seen that completely reverse a big drop in the after-hour session or a big gain, and that's what happened here with Amazon. So I forget where it was, but it did on that, if you include the intraday moves, and I can't turn them on now because we're 3 days beyond there. It put in a divergent high, and it also was followed by, remember, pre-earnings, you had a breakout above the 200 days, which I said you should take with a ginormous grain of salt. That happened the day before earnings. You don't take breakouts that occur the day before earnings reports or on the day of, if they're reporting after the close. And then you had a failure. So that was and is, as of now, a bull trap when you break out, because the 200 days are just, again, I've covered this off, and I don't want to, I encourage you to watch some recent videos so I don't go over every single thing I've covered, but the 200 days have just done a phenomenal job of containing this stock during the bear market, as they did a really good job of containing it on pullbacks in the bull market. And so that's it. Failure, false breakout, and solidly below the 200s. And as of today, I had a price alert go off this morning. We've now taken out this uptrend line off the lows, and it's fairly well defined. You had some distinct reactions coming off the March lows there, a couple more candles there, one recently, and then on Friday we hit the bottom, hit that, bounced, and now we've taken that out. So it is only one stock. Of course, Microsoft's doing pretty well after earnings, and technically is in a better technical posture. So I will say there's a little bit for everybody here, bulls and bears alike. I'm just saying this is one to continue to monitor. If the rest of the fangs go up, Amazon will most likely follow suit, and so maybe this will be the whipsaw, but as of now, that's all I can tell you definitively. Rejection at the downtrend line, false breakout, and failure back below. Now we're solidly back below the 200-day moving averages, and today's only Monday, so let's see how we close the week. See if we close them on a weekly time frame. Hell, the day is not even over. We're below that right now. The trend line, we could recover it by the close, but if we don't, just a little bit of a red flag there. The other ones I wanted to point out is one they used to be called the fangs with an N, is Netflix. And here's my chart on Netflix. Netflix is in a big triangle pattern. You can see by these two lines here. I'll draw it up on a clean board. You have the all-time high. Its bull market high is there. Come on down. Draw a line there. You're going to catch. Make sure you use log scaling these recent highs, and then you can also draw a trend line off the lows here. Like, let's come in like this is how I have it. really does a good job of capturing these recent reaction lows, pretty much down to the bottom there, and that's a big symmetrical triangle pattern. And typically, whichever way this thing breaks, not guaranteed, is the next major trend in Amazon. I'm sorry, Netflix, one of the big FANG stocks. And you had a big old massive gap here that was very technically significant. If you take that across, we're at that level as well. So I just want to point this one out. It doesn't have the weighting that it used to have, but it's still one of the big ones to watch. And I just want to point that out. Now, okay, I'm going to loop back and come back in with Amazon. And here's what we want to watch. You've probably heard this before, but if not, I'll reiterate it. That consumer spending accounts for over 2/3 of GDP, gross domestic product. Consider that the earnings of America, if you will, to use simple terms. And so, in other words, the consumer has a much larger impact on the economy than does even the federal government, who, as you well know, in recent years, recent decades, just spends more and more and more. And that's something I'm going to get to in a second, talking about the debt ceiling coming up here. Anywho, XRT, just keep an eye on this. This is, again, the retail sector ETF. If you kind of want a good pulse on the retail sector and consumer spending, of course, you'll watch XRT is a pretty good proxy. There's a little uptrend line there. And you can see, unlike it's like a lot of sectors, really lagging. This, and I've commented on this before, I truly, to me, guys, this is the twilight zone for me, fundamentally. I think we're in a very, I've said it. I think we're setting the stage for a market crash. And I usually, I'll say that term. I'm talking a big drop, a swift drop, 20-30% drop. For red flags that I'm seeing, and for the first time in history, big tech is considered a safe haven stock. It has exhibited traits of flight to safety throughout since the whole banking crisis started. We'll get to that in just one second. I'll talk on the failure of First Republic now. This is twilight zone to me. That the market's holding up despite everything, the trend we're seeing, a trend that was predicted and the trend that's materializing, but yet the market's just shrugging it off like it's nothing. One bank failure after another, and big banks too, so we'll get to that in 1 second. Anyways, watch XRT. It's below the 200 days. It'll turn off all the lines here. The red and blue lines are the 200-day moving averages. They typically, contain things in a bull market. When you cross below them and you're solidly below, like COVID, you're in a bear market, and you've been below and you got rejected. Like I think the S&P will prove to be the S&P 500. You had a nice breakout. You took them out there. XRT took out the 200 days, but this whole thing, the breakout above the 200-day simple and exponential, proved to be a false breakout, and we're back below them. So that in itself is bearish. The fact that you couldn't hold them. That's what it looks like on my weekly chart, longer term chart. And what I wanted to do is just go through a few components. I won't go through them all. I'm going to click through these components in order of their market cap weighting. This doesn't necessarily mean the same order that they're weighting in XRT. I'd have to look that up. A lot of ETFs or sector to track sectors aren't market cap weighted. So in other words, their components doesn't necessarily mean the biggest component market cap wise is the top component of that ETF. Or that's, if I said that correctly. Amazon, I already covered, so this is my busy board. Walmart, second largest by market cap in there. Amazon is a $1.1 trillion company. Walmart, way down the line now, 408 million, but still a respectable size company. And of course, the takeaway here is, Walmart, if the economy is holding up and the consumer spending, Walmart's going to be making money. If the consumer tucks in a shell, we're in a recession or headed that way. From a technical perspective, I haven't cleaned this chart up in a while, but I can tell you this is the first divergent high I've seen since this one back here. This is when the bull market ended. That was the all-time high. That was back in mid-2022. Walmart peaked on a divergent high, took out a trend line, had this kind of wedge type pattern. There was your sell signal after the divergent high. We had something similar here, and it also failed at that previous reaction high. Look, it's not nail in the coffin type stuff yet. It's not far from the breakdown point, but if you zoom in there, you can see there's your divergence. equal or lower lows in the indicators, BPO and RSI, break down and we're below there. So just keep an eye on it. And the level to watch now, you have two reaction lows right about equal there at about 150 and a quarter. So a break below 150 really would do the trick there. And so if you start seeing these leading retailers buckle, that is a red flag. Again, doesn't guarantee anything. It's just things that I'm watching. Here's Costco. Costco, I see the same thing as Netflix. I see a very big, nice, pretty nice and clean symmetrical triangle pattern there. That trend line goes way back on Costco. Look at that uptrend line. Let me find a clean board for you and draw it. That one I had there comes back here like this, and lots of reactions on it. That goes back to 2017, and so there's your triangle pattern there. So keep an eye on that one as well. Triangle patterns are indecision patterns that can break either way, so let's respect the way they break, and these are things that I'll revisit or will, that have the potential to start changing my outlook. I start seeing a lot of upside breakouts. If QQQ can bust out through the range and run, great. That's going to change the technical outlook, and then things will change for me. So Costco, a couple others, TJX, which is TJX companies. They own TJ Maxx, Home Goods, all those, a lot of those discount type, excessive inventory retailers. All I can tell you is divergent high and a potential trend line there. I don't have a very strong opinion on that one, but I do see, again, divergence. If I had to bet one way or the other, I'd bet down based on that chart. Target, I don't have much of an opinion on Target. That's the thing. I don't force opinions on stocks. So I can tell you it's sucking wind. Here's a stock still well entrenched in its bear market. I mean, not even close to showing any signs of it being out of a bear market. And there's a pretty significant trend line from 2017 plus price support just below, so you want to watch that level. All right, I'm not going to go through each and every one. I'll stop here. O'Reilly has this big old, you can even see it better on the weekly chart. It's just a nice clean uptrend line. Divergence has been building for a long time on that one. That's O'Reilly Automotive. So I just wanted to give you a kind of a heads up. Keep an eye on that sector. A lot of those are above trend. Some aren't. Some have broken down recently, but they will, give us kind of clues to the economy and how the consumer's doing. All right. Okay, I'll wrap up with gold, the euro, federal funds rate. I'm not going to get too deep into the banks. I'm just going to say, we know what you should know what happened. If you're listening to my voice and you follow the markets, you watch the news, you read the headlines. So now it is official. I said last week it was likely to happen. We all knew that. First Republic down. So today's headline is yesterday the First Republic failed. They came in and shut it down. They actually arranged a buyout by JP Morgan. So yes, the big get bigger. The too bigs to fail. This is nothing but the same. This the Fed hasn't changed. It's like Wall Street. Powell fiddles while Wall Street burns is what's going on here. It's just been a very consistent pattern. I'm not the only one, but I projected a lot of cracks in the financial system for these rising rates and being mainly too low for too long. I've commented on that. A 4 or 5% federal funds rate is still historically low. It's just when you give the market nearly 20 years of near zero rates, it becomes accustomed and ingrained. It's just like a heroin addict. You do heroin once, you're not going to necessarily be a lifelong addict, and you certainly wouldn't have withdrawal symptoms and die if you didn't do another shot of heroin. You do heroin for 15, 20 years, you can't stop. Your body will shut down on you. You have to taper down, and that's the same thing with the rates the way I see it. And so what was it? We had FTX and all the other crypto exchanges and crypto, all the cracks there and the breaks. That was the early signs. And then we had Silicon Valley Bank, Signature Bank, and this was just recently. Silicon Valley Bank was the second largest bank failure in the history of the United States. That's behind Washington Mutual in 2008. And then what do we have yesterday? Well, First Republic, which is now the second largest. So it was even bigger. And so, okay, of course, everyone's over. And look, yeah, is the Fed going to do what it takes to shore up the banking system? Absolutely, but the markets, just humming along because the great Jamie Dimon said everything's fine, the banking sector's fine. Well, of course, he just got um, even bigger today with taking over at FRC, First Republic. Anywho, I just wanted to say that this is not a sign. This is there's just so many red flags, and maybe it all goes away. But again, look, guys, we'll see. Go back to the technicals, and we'll just see if QQQ and SPY. I didn't mention SPY, but it also has the negative divergences as well. And if it can just burn through those divergences like they're not even there, then hey, that's pretty bullish. But as of now, we're still, you go back to my bounce target zones. Remember, I laid them out in the beginning of the year. I was busy on this board, but the red was my most likely bounce target zone, which we're right at the top of now, and then the purple was my max bounce target zone on SPY. I don't talk about SPY as much as QQQ. That one's really what I'm focused on, and we're still right smack in the middle of my max bounce target zone with those divergences. So that's it. And again, Fed on Wednesday, Apple on Thursday. I expect nothing short of phenomenal blowout earnings on Apple, but we'll see where they go. And of course, that's one to watch. I mean, that goes without saying. Remember, Apple, we have that. Reminds me a lot like Amazon, where it had a little, except we had a little false break, the nice cleanup trend line before. But again, that was pre-earnings. So I'm trying to put an X through there. You don't, it's not a breakdown you take, and it was recovered. So this trend line is still valid, and the big divergence that you have on Apple still tells me that although anything is possible, this is certainly possible. This is most likely or most probable. I always say that I talk only in probabilities because anything is possible. Just about anything is possible, that is. But in trading and investing, all we can do is try to quantify the probabilities of something. If the probability is 50-50, why bother? Go gamble in Vegas. At least you get some free drinks and get all the lights and sounds and that whole thing going. But trading or investing, you want to put the odds in your favor. So I still think the odds say down at this point in time, down big again. And it's a lot of quotes out there. Some of them from Jesse Livermore. The waiting. He cited as when paying off eventually. And so again, this has been frustrating with QQQ going sideways, and in the fact it could even go up a little higher before we drop, or we don't drop at all, and then guess what, move on to the next one. I'll take my losses on these swing and trend shorts, and certainly won't be adding to them, like I said, at this point if we go up anymore. There's a lot of quotes out there too about averaging down on a position. So I want to wait and see, especially see again last Tuesday's lows get taken out before adding to any more short positions on the NASDAQ 100, that is. Now there's a lot of individual stocks out there with plenty of nice setups, both long and short, and that's probably the best thing to, if you're going to continue to trade until this market makes a definitive break one way or another, that's what you probably want to focus on, individual stocks. All right, let's so we talked a little bit about the interest rates, and let me show you. Here's the Fed funds rate. Current target rate is 4.75 to 5%. Pricing in a 93.5% chance of a quarter point hike. Let me refresh the page and just make sure that's still up to date here. Dropped a little bit. I said this the other day. I haven't been reading up much about what the Fed's saying lately and what the mindset is, but I have seen a pretty decent abatement in inflation, and as I just said, and this is why I said earlier, it seems like we're in the twilight zone here. We had just a month ago or so, the second largest bank failure in U.S. history, 2 banks going down in short order at that time, and we've already broken that record now with FRC. So where I'm going is, I guess one thing about the Fed is they don't surprise. We haven't had the Fed years back, decades back, stopped doing surprises. If anything, I think they're too disclosed. They telegraph what they're going to do, and they're afraid to shock the market by doing anything different. But I don't know. I just can't understand why they wouldn't at this point hold tight and just say that they're continued to going to monitor inflation and do what they need to do to control it. I don't know. Maybe it's because they already said they were going to do it and they're trying to hold on to that credibility thing. But what I'm going with this is, for some reason, if they don't hike, and you've got a 90+% probability, it was 93 this morning, priced in that they're going to. You can look at it both ways. I know that sometimes they say, well, if that happens, and people might say, the Fed knows something we don't, and so then stocks could go down. But it would also, you could very much make that bullish case with the stock market surging on the fact that they didn't get another rate cut. Look, I don't know which one, guys. I'm just going to tell you, I wouldn't be super heavy long or super heavy short come Wednesday afternoon. And markets volatility is going to pick up this week. I told you last week it would probably be through this week until the trading range is resolved, because of the Fed, and then because of Apple, who comes on Thursday after the close. So we'll watch this, and you can keep an eye on the Fed funds rate probability, and of course keep an eye on the charts. Okay, and all this stuff is related. So even if you don't care to trade Treasury bonds, you should keep an eye on them for clues to the stock market, clues to the economy, what's going on in the financial system as a whole. So this is TNX. This is probably the most watched of all bonds traded. The 30-year has a little more volatility, typically pays higher rates, but even your 30-year mortgages tend to track to the 10-year Treasury bond better. So it's right there in the middle. That's our primary secular bear market downtrend line. I've been talking about this for many years. This is where interest rates peaked in our last inflationary cycle back in the early 80s. And we've had a very clear, unmistakable downtrend since then. It was in a channel for a while, walking its way down, and then we had these bouts of quantitative easing starting in 2008, and all this, and then the all-out nuclear response when COVID hit, and now that slung us down, and then we made a quick up and a solid breakout above the channel. So this is, plays very largely into my longer-term outlook, that I believe that we've started a new, we've certainly ended by every metric, both the downtrend line being taken out and previous reaction highs being taken out. That eliminates the downtrend that we were in. Now, doesn't guarantee that we're going to start a new secular bull market, but it certainly sharply increases the odds. It pretty much says that primary downtrend was over. And so I'm going off the thesis that we're probably in a new secular bull market, early stage, and how it's going to develop, we'll see. The only time will tell, but we'll watch. And one thing you want to watch for is, are you going to remain above this previous reaction high right there? So that's also support. It's a really nice support level, and we came close to it. But I wanted to point out right here, I need to move this trend line to accurately fit right here and get these reactions. So you have the 10-year, give or take, right around that uptrend line right now, and it's still well above the primary downtrend line right there and above support. So let's just watch this and see what happens come in the coming days to weeks, because this will likely have an impact on the market. The market, just remember, higher interest rates go, the more that's going to stifle economic growth. And there are two things. Now, this is what I wanted to talk on. There are two things that most likely will drive interest rates up. Number one being inflation. Inflation goes up. The Fed's forced to raise rates to slow things down. That's why you had that surge of rates back in the 70s into the early 80s. That was our last true inflationary, especially hyperinflationary environment. There's that uptrend line that you can see on the weekly we're right at right now. The other thing now, and I'm sure this is being talked about to some extent or the other, but you've probably, if you do follow, financial markets and global economy, you know that a lot of countries are trying to get away from the U.S. dollar as the world's reserve currency, and that's it's not talk anymore. It is action. You're seeing little by little here and there things changing and things being priced and traded it out, no longer in U.S. dollars, including crude oil. So uh, a lower demand for dollars and treasury bonds is one thing. Now you also have the debt ceiling coming up. As we all know, they're not singing kumbaya, the Republicans and Democrats together up there in Washington. They hate each other. We're as polarized as we've been since I can remember my lifetime. So let's see where we go with that. And so all of a sudden now we're going to get to the point, and that's going to start to be an issue. And then if we, can't agree, and you get a partial government shutdown like we had was last time in 2011, and then the U.S. debt, if you recall back then, was downgraded for the first time ever from AAA rating, or at least in many decades, if not ever. So what happens there? If there's a problem there and you see selling or less buying of treasury bonds, remember the other component, I just told you that one thing that causes interest rates to go up is inflationary, high growth environment or inflationary environment. The other is lack of demand, because the way bonds work, if you have a bond paying, let's say 3%, a treasury bond, and there's no takers at 3%, no one wants to buy it for whatever reason. Well, the bond rates, Fed does not set the treasury bond rates. They don't even begin to set the treasury bond rates. Bonds go to auction, and they'll come out at a certain rate, but then once they go to the auction, supply and demand will set that rate. So the bottom line is, if there aren't any takers at 3, and bonds are going to have to go up, let's say 4, and then 5%. So when demand goes down, not enough buyers, you're going to have bond prices go down and rates go up with fewer price. Think of it that way: supply and demand. If you have a lot of people buying bonds at once, it causes the price of the bonds to go up and the rates move inversely. So anyway, that's just something to watch here, and that in itself could be a reason why we see rates go up, which then would be stifling for economic growth. So I just want to point that out. At the end of the day, watch it. Just watch the bonds. I recently threw out some ideas on the 30-year bond and the 10, but this is the 30-year. It had really nice resistance, that resistance zone, divergent high. You had a big correction, divergent high, correction, second divergent high, double top, bigger correction, divergent high, another correction, divergent high, correction, and here we are. And I wanted to point out, and that's why I'm coming full circle here, we just took out that trend line that we had been flirting with, and I told you back here when we hit that was that short, which remember I took that as a hedge, shorting treasury bonds as a hedge to my index shorts, which paid off because that was profitable, with the point being that if stocks went up, treasuries will most likely go down. They also tend to go up and down as a flight to safety bid. When the stock market is weak or the institutions think it might drop, then they buy treasury bonds, which pushes the price up. So you're seeing that right now. And again, it's going to be a little erratic with the Fed this week, but I just wanted to point out that technically we just broke that trend line. I don't have a position right now, not too sure, but I think I told you back here after a little bounce, figured we'd get another leg down, and that other leg down could take us here, and that's where I would, if I had to make a bet, that's where I bet that we're going to go head on down in treasury bonds. But let's see what happens, and that means again, prices down equals yields up, and that's not going to be, rising yields. You start to get at that ceiling on yields. That's not good for the economy or the stock market. Gold hasn't been doing much lately. Remember, we put in that island top right there, more like an abandoned baby candle, with the little doji candlestick separated by gaps on both sides. We've been moving lower since. That also coincided with a divergent high. So I have mixed feelings. The cross currents are, you're getting a flight to safety bid. Everybody wrote gold off for good. All the what are crypto heads or whatever you call them, a while back when the first one, when Bitcoin was in a roaring bull market before the bear started, that gold's dead, crypto's the new safe haven and alternative to the fiat currencies, blah blah blah. And I said that's ridiculous. Gold's been, you know, store currency or a flight to safety and alternative investment, and also an inflationary hedge for many years. And so, you know, I can sit here and make a longer term bullish case, and I had been for a while. I'm just kind of not, my convictions haven't been high, and I can tell you with that divergent high, technically there may be some more downside in gold coming up. It's hard to say. I think I feel strong. I think it would have dropped a lot more had we not had this banking crisis recently. That is by itself giving a flight to safety bid into gold. Remember, we also had a island top right there on that major high. So look, I don't have a very strong opinion on gold right now is what I wanted to say, but I'll give you levels to watch because I'm sure there's probably questions on updates for that. Remember, we put in on this is a 2-hour chart, 120-minute candle charts of GC gold futures. We had a beautiful, nice, clean, well-defined uptrend line there, sell signal after that divergent high, gave us that correction, ran us right into that divergent low right there, double bottom. That first one was a divergent low, and this just extended the divergence, kind of like what's going on in QQQ right now, but in reverse. Then you got the rally, and most recently you put in a divergent high here, and you took out this trend line. So you had a wedge, another wedge, just like back here. And you broke down, but it's been moving a lot like the stock market, sideways. So here's a message. If you're frustrated lately in the past month or so, I do this, I've been used to in the last couple of years, quick turns in the market, quick turns in gold, silver after breakdown, sell signals. This is just like a big period of indecisiveness. And again, I think that's the reason is technically, and it did correct off the wedge break and the divergent high, but there's cross currents between technicals and fundamentals. These are unique times. Let's just say that. So I don't know. Not a strong opinion right now on gold. There's a support level right there. That line goes all the way back to right here, really. And you've got sort of a triangle pattern. It tried to punch it today, but it got rejected, and it's still in there. And again, remember, the important thing about gold and silver, I'll get to silver in 1 second, is it's all about the euro and the dollar. It's really about the dollar, but the euro, I track the euro-US dollar pair. And depends what the Fed does. This is the euro right here. You put in a divergent high there, the euro-US dollar pair, I'm sorry. So when this goes down, the euro's falling against the dollar. The euro's going down, the dollar's going up. I use this chart because gold is positively correlated to the euro because it's negatively correlated to the dollar. So if you can predict accurately where this is going, you can predict where gold and silver are going. And what I see, and that's the reason I backed off of about a month ago of my longer term bullish outlook on gold, big negative divergence on the euro here. And that divergence has been growing. We had a correction, shot off the bow on the first divergent high, and we only extended or made that divergence even larger since then, setting the stage for a much bigger drop. That would mean euro down, dollar up. Okay, and if that happens, that's most likely gold down and the stock market. The stock market's had a very high correlation between the euro. I've covered that recently, but I'll do it one more time for you. Here's the daily chart, euro US dollar. Let's just compare gold and silver and the S&P 500. We'll do the NASDAQ 100 in pink or purple, whatever that is. And you can see very, very strong positive correlation. You can't, there are periods of disconnect. Here's one period where the NASDAQ 100 fell. Remember, the purple is the NASDAQ, and they went up. But other than that, they've been moving in near perfect lockstep. They tend to rally, especially the bigger trends. They all, NASDAQ bottom back here. They all peaked here, right there, had a correction. Then they all bottomed here and have been moving up in near lockstep since then. So that's it, guys. So there's going to be a lot coming up here. The markets, what the Fed does and what the Fed says on Wednesday is going to impact the stock market. It's going to impact gold, silver, most likely. I told you I'd give you silver. There's silver. Silver had a nice clean trend line here. And big support right there, big, because it's really a support zone, but you can see it was all capped, all the advances back here. Let me try to get my drawing tools set up here. Capped all these advances back there, and then we had a breakout, Been back testing it, back testing, back testing, back testing. So this is good support. Yeah, the trend line, it broke out today, but then they sold into it and are right back to it. So that's it. So if I had to bet, I'm betting down in silver and gold for that reason. I'm betting down in the euro, down silver, gold, down the stock market. I hate to be Debbie Downer, and hey, more so, I'll hate to be wrong. I'm doing what I do, you do what you do, but that's the way I think we're going to come out of this week after the Fed and after Apple and everything else. And remember, they're all correlated. So maybe the Fed does something, the market initially reacts as bullish, and the market starts to rally, and then Apple comes out, and for whatever reason the market doesn't like what they're selling on Thursday night. Apple goes down as the largest component of the Nasdaq and S&P. It takes the market down, and then all of a sudden the euro follows and gold and silver. So just recognize that these correlations are the correlations in recent months and even the last couple of years. And so therefore, also the last takeaway I'll leave this with you is that if you are trading right now gold, silver, GDX, any of these things I've thrown out in recent months, Nasdaq 100, S&P 500, the euro, the US dollar, know that you are not diversified because of that correlation, although they are completely different asset classes. Currencies, precious metals, commodities, and the stock market, or equities. So you might think, oh, I'm diversified among, right there, a half dozen or more positions, and also have asset allocation among different asset classes. Well, no, because you've now lumped into things with a very high positive correlation. So although you might be diversified in theory, and in reality you're not. So just keep that in mind. So there are things, I got to stop this video here. There's, there are other things that you could be positioned in, long shorts, particularly in the commodities arena, to get better diversification. And I told you I'd stop the video, but I wanted to give you one more sector to watch too, and that's the home builders. I think we're looking at a nice short trade coming up. XHB, a lot of people talk about that one as a home builders ETF, but that's so heavy in Home Depot and Lowe's and companies that are not home builders. They're just lumped into that ETF. ITB is a little bit more concentrated on the home construction index, and the home builders, and it does have Home Depot and Lowe's, but I just wanted to say that you've got pretty big divergence forming on it right now, and it's at resistance. It's a hair above it, so just watch. If it can power on through, maybe burns through the divergences, but if it falls back below 74.33, which was resistance here, then it was support, support, support. That's where they gave up the ghost back here and then broke that trend line. And from there, the home builders fell about 37%. So it's a pretty big level. And so if the home builders fall back below their ITB in particular, and then breaks down below this bearish rising wedge, that's going to send the home builders back down, or ITB, to, I would put very good odds on my first target being hit. That's about 65.50. It's an excellent first target. Gave a little bounce, and then possibly more. Again, if. So there's some ifs. You need to reverse. You need to break support, just like the stock market right now. QQQ needs to, fall back in the range. Number one, solidly within the range. Then it's probably going to the bottom of the range, but it still has to break that, Tuesday's lows. So those are the ifs, or the conditionals for QQQ on the downside. All right, I'll wrap up here, and this will probably be the only video for today. I've got some things going on around the house, so I gotta tend to that right now. But let me wrap up here. If anything stands out before the close today or after the close, I'll do another video or get at least a static post out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.